Steve, you've covered Salesforce. Is that next?
I've been looking at Salesforce. Yeah, they've reported earnings. I always like it when Salesforce reports earnings because it tells me the earnings season is nearly over and I can stop raiding through these things every day. So Salesforce, they're an interesting stock for a number of reasons. They gave their guidance for what they call fiscal year 2023 because they think that's what year it is because of complicated accounting reasons and stuff. So it took a little bit of working through on some of this stuff for me. But here's the general sort of gist of things. The market didn't like it, by the way, and I knew the market wasn't going to like it because my phone was blowing up with updates saying that nearly everybody from Citigroup through Barclays through Morningstar had downgraded this stock, or at least lowered their price target or fair value estimate on it. This morning, I had notification after notification after notification. It went down about 7.5% out of the gate. I'm not quite sure where it ended up today. But okay, apparently a disappointing sort of quarter then for Salesforce. What did that look like? Revenues then were 7.72 billion, which was up 22%, according to the numbers I'm looking at here. Different in constant currency, slightly higher, but let's call it 22% for the moment. EPS, you have a choice of EPS number. It either made 7 cents per share, or it made $1.19, depending on whether you take GAAP earnings or non-GAAP earnings. And when I looked at this, I thought to myself, I'm going to talk about this for ages just to annoy Paul. But Paul isn't here and he probably isn't listening, so I'm going to talk about this for ages. Mostly because that distance between those two things, and you hear a lot of GAAP versus non-GAAP stuff, but the distance between those is like 17 times. And I thought, well, it's probably worth trying to figure out what that is in that case, because I get that sometimes companies think, well, look, GAAP accounting doesn't give a true and fair reflection of our company and where we're at and our progress and so on. So we're going to tell you a number that we think does give a fair reflection of it. But then the question becomes, well, what is it that's kind of the difference between the two? Okay, here we go then. The difference between the two EPS numbers is that their non-GAAP EPS, the bigger number, the number they'd like you to pay attention to at $1.19, is leaving out the following things. It's leaving out amortization of intangibles for 49 cents, stock-based comp for 85 cents, and some income tax adjustments for a boost of 22 cents. So those are the three things that they're suggesting they leave out, because I'll read you the bit from the slideshow. Non-GAAP diluted earnings per share excludes, to the extent applicable, the impact of the following items: stock-based comp, amortization of purchased intangibles, and income tax adjustments. These items are excluded because the decisions that give rise to them are not made to increase revenue in a particular period, but instead for the company's long-term benefit over multiple periods. In other words, what they're telling you here is that, look, it's not here to distort the number for this particular occasion, it's there to give you a view for how we're moving in general terms. Make of that what you will. That raises the question of kind of stock-based comp, I guess, and whether it's a good thing. There was sort of 85 cents worth of stock-based comp that they were adding back in. It's by far the biggest thing that they're adding back into their EPS to get to non-GAAP stuff. Steve, do you have a view on stock-based comp?
I have the same view as you on stock-based comp in that I don't like it, but I think I'm fairly happy with a company like Salesforce that's growth outstretches its growth in its top line, outstretches its growth in shares outstanding, which Salesforce just about does. It is pretty egregious with its stock-based compensation. This is probably part of the reason why it wins awards every year for being the best place to work, because it's just throwing money at its employees. But also you've got to factor in the fact that, you know, it makes a lot of acquisitions, and it makes a lot of big acquisitions, and bringing those people on board and keeping those staff and retaining those staff, you have to give them stock in an accelerated fashion, or replace the stock that you have that you've bought off them when you acquire the company. It's about keeping. There's a reason you buy a company like MuleSoft, and it isn't because you quite fancy owning MuleSoft. It's that the staff that built MuleSoft you think are incredible, and you want them as part of your organisation. So I think that's coming to an end for Salesforce. So I would be intrigued to watch that stock-based compensation metric from this point onwards. But Steve, I'll let you carry on because I don't want to steal your thunder.
Yeah, I also would be interested to watch that keep going. You made the point that we make a lot because we both think it's the right one, which is that, look, if you want to grow your top line at a particularly high rate, you will probably have to pay for that somehow. And it's okay to pay for that using equity if you want, especially if you're a company like Salesforce in growth mode. But you hadn't better pay more equity than you're getting back in terms of growth. It's the sort of straightforward thing here. Okay, so revenues were up 22%, which to me sounds like a fairly decent number and sounds fairly close to what I was expecting from Salesforce. So the question then becomes, why did stock down so much at 7.5%? And the answer is, well, certainly here's one reason, and it's that guidance isn't that good. Or at least guidance came in lower than analysts were expecting, and you disappoint the analyst and your stock goes downwards. This is why it's getting downgraded a fair bit. So, guidance for the year was for around 31 billion. Analysts looking for around 31.8 billion, according to Steve D owned Refinitiv. Earnings per share guidance was 4.71 to 4.73. Analysts looking for 4.75. Guidance for the next quarter was revenue of around 7.82, looking for 8.07, and earnings per share of 1.2 versus 1.29. Basically what's going on here is sales cycle is getting stretched out a little bit, and they're seeing some impacts from foreign exchange, which basically means that companies are a bit slower in renewing, a bit slower in signing up. They're sticking with products they have rather than adding more on or upgrading them or moving them forwards, I think is what I'm kind of hearing on that.
The guide on revenue, Steve, could you just give me that again, please?
The year or the quarter?
For the year.
I think I have 31 billion as opposed to 31.8 expected.
That's interesting because they were actually guiding for about 800 million in FX impact. So essentially that guide is on the money.
Yep.
So I've just pulled some extra stats out here, Steve, that I was looking at when I looked at the annual report. And the annual report, for what it's worth, is the best annual report that you could read, the best presentation for anybody who's interested in Salesforce. They break it down in such a brilliant way. You can fully understand as you flick through these 60 odd pages, or it might even be 50 pages, and they just explain every aspect of their business and break it down for you so you can see how it's grown. So here's some of those things. So the service sector of Salesforce grew 23%, the sales sector grew 15%, platform revenue grew 19%, marketing and commerce grew 28%, and MuleSoft and Tableau, they grew 31%. They were also just showing us how good they are at M&A. So Exact Target that they bought for 2.5 billion has 8x'd its revenue in the 8 years since they've acquired it. Demandware has 12x'd its revenue. MuleSoft has 23x'd its revenue, and Tableau has 12x'd its revenue since they've got it. So I mean, they're kind of showing you there that they're doing a pretty good job when it comes to acquiring these companies. Just to let you know as well, just to add on, the difference between what they're guiding for and what they've actually done, so the full year guidance, is what they managed to do in revenue in full in 2015. So what Salesforce are actually expecting to add on is about 5 billion, give or take. And they did 5.4 billion in 2015. So that is, that wasn't that long ago, Steve, to go from a 5.4 billion company to essentially a $31 billion company. You've got to factor in the fact that they've acquired, a hatful of companies in that period of time. But they're going to do a big buyback, Steve. Did you spot that?
I did see they're going to do a big buyback of a sort. Yeah, I was reminded of it when you said in the case of stock-based comp, you need to either make sure you're growing it faster or offsetting it with a buyback of a sort. And I found this kind of interesting. Salesforce has never done a significant amount of buying back before, but their board has approved, I think, 10 billion in buybacks. And at the time I looked at the market cap, obviously this moves around and may well be in a different place by the time this goes out, that was about 5.5% of the market cap to come back in. I didn't pick up what time period that's over and whether that's opportunistic or whether it's to be done in the next year or in the next quarter or whatever, but I found myself wildly in favour of this. I'm not a Salesforce owner, by the way, but if I were, I would be strongly in favour of it. What did you think?
Yeah, I'm also wildly in favour of it as well. I think it's about time they started trying to counter the dilution that they offer, in getting staff on board. I'm expecting less stock-based compensation anyway next year, and I'm expecting this to potentially even bring that number down. You would hope 10 billion brings the number down, wouldn't you? But just a couple of other things I noticed. They've now got an A+ S&P global rating, and they've also generated about 5.5 billion in operating cash flow last year as well, which is quite impressive for a company like Salesforce, especially when the difference between their non-GAAP and GAAP is astronomical. So when you end up looking at something on I don't know, Yahoo, and you're screening for a PE ratio or something like that, there's just no way you would consider it because the PE is probably going to be about 300. But
Right.
in reality, Salesforce is a completely different kind of company. They also announced that they're now officially the fastest growing enterprise software company ever, Steve, with 21% year-on-year growth. That actually beats, from inception, Microsoft, Oracle, and SAP as well. So there's plenty in this this guide that I could tell you about, but I mean we've got to press on, Steve, because we've got a lot more stocks to cover. Are you buying Salesforce?
No, but I'm never really quite sure why. I feel like it's not a sector I understand terribly well, but it feels like everything was written there for me. Churn was pretty low again, 7.5%. If this company starts buying back shares, then I think good things are going to come its way, because I actually think this stock is kind of undervalued at the moment with where it is, especially down another 7.5%.
I agree.